Good morning, everybody. It's my pleasure to moderate today's panel on biodiversity in the context of an event mainly dedicated to climate change, as these two topics are so strongly interconnected and should be considered in a similar way. My name is Odile Conchou, and I am the focal point for the financial sector, responsible for developing and managing a program of actions with the financial sector at the Secretariat of the UN Convention on Biological Diversity, the CBD. Today, our panel will discuss how companies are now considering or starting to consider biodiversity loss along climate change in their strategies and investment decisions. And they will also discuss how they can identify and quantify the risks and dependencies that materially affect their business. The question now is no longer why companies may be affected by biodiversity loss. There are many studies, reports, and facts, but attesting that, but how they can act and what they can do or are already doing, and how they can build on the experience of climate change in terms of risk management and new market development. So, to discuss these two main questions, we have today a very interesting and diverse female panel to discuss these topics. It's my pleasure to introduce our four talented panelists. Mrs. Elisabeth Maruma Mrema is Executive Secretary of the Convention on Biological Diversity, one of the three Rio conventions. And Elisabeth, you are also co-chair of the TNFD, the Task Force on Nature-Related Financial Disclosure. You have worked in the United Nations Environment Programme in various positions, including Director of Law Division, Deputy Director of the Ecosystem Division, and other positions. And you are a lawyer by training. Mrs. Vicky Benjamin, I don't know if I pronounce well, I do that the French way. You are the co-founder and CEO of Carnable Capital, a socially responsible investment firm building innovative investment strategies dedicated to protecting the planet's biodiversity, fostering environmental stewardship, and conserving nature around the globe. You have 25 years of experience in the financial sector in various positions at the intersection of finance and sustainability. Mrs. Sarah Adams, you are the co-founder and the Chief Sustainability Officer of Ver Asset Management, a dedicated ESG asset manager which was created to bridge the gap between financial services, capital markets, and environmental advocacy. You have a multidisciplinary experience across the finance sector and environmental policies in various sectors, notably in the sustainability education. And Mrs. Rachel Kite, you are the co-chair of the steering committee of the Voluntary Carbon Markets Integrity Initiative, a global multi-stakeholder task force on financial principles for inclusive sustainable development. You are also the 14th Dean of the Fletcher School at Tufts University in the US, and the first woman in this position, it has to be said. You have worked in several organizations as the UN, IFC, the World Bank, where you were the group vice president and special envoy for climate change, leading the run-up to the Paris Agreement. So as you see, a wonderful panel, very powerful panel. So I will begin to ask you first question to all of you, and we'll precise afterward. How are you now considering or starting to consider biodiversity loss alongside climate change in your strategies and investment decisions? And what are the most concerned sectors in your portfolio, if any, because you don't all have a portfolio? That's your case, Elisabeth. I will ask with you. You are not an investor, but you are involved in the design of an international framework, the Global Biodiversity Framework, which, when adopted later this year, hopefully, will have direct consequences on the way the financial sector and corporate do business. Can you explain to our audience what is this Global Biodiversity Framework, why it's important for the financial sector and businesses, and also the link with the climate space? Elizabeth, the floor is yours.
Thank you very much, Odile. Let me begin by greeting all of you and our listeners or watchers. Good morning and good afternoon. And sincere thank you to The Economist for this invitation. Last year, our Convention on Biological Diversity Conference of the Parties 15th, Part 1, which was held in China, as well as the Climate Change Conference of the Parties 26, held towards the end of last year in Glasgow. Both the two demonstrated as never before that climate change and nature are interconnected, and that we will not solve the climate crisis without nature. Neither will we solve the biodiversity crisis without addressing climate change. They have also made it clear, or a clear case, for social challenges of these crises and the imperative to include people, local communities, and indigenous peoples in the solution for these two crises. Furthermore, both gave us, finance and business, a clear message that both need to simultaneously shift to nature positive and net zero models. At the beginning of this year, the World Economic Forum launched its Global Risk Report for 2022. This report highlighted that three most severe risks at a global scale over the next 10 years are climate action failure, extreme weather situation, and biodiversity loss. And the five most menacing long-term threats are all environmental. Indeed, 2022 is a new challenging year for nature, with notably the venue of the second part of our Conference of the Parties 15 in China will be a place where an ambitious, transformative global biodiversity framework will be adopted. It will be our future global blueprint policy for biodiversity for the next 30 years, and it will be adopted by all our parties, which are virtually universal, 196. It is therefore important to understand that this framework for biodiversity will be like the Paris Agreement was for the climate change. The framework, once adopted, will give a strong political direction to engage and put nature on a path to recovery by 2030. It will also be our framework for the next decades and beyond until 2050, where we hope to achieve the Convention's long-term vision of living in harmony with nature. Furthermore, the framework will be translated into policies and regulations at regional and national levels. It will have direct consequences on the operations of companies and financial entities. Nature loss represents significant risks to cooperate and financial stability. The involvement of all actors besides governments, including business, the public, and the private financial sector across developed and emerging markets are fundamental. There is therefore an urgent momentum to see across all strands of the economy, including financial institutions, to restore and rebuild nature. And lastly, there is indeed an urgent need to consider nature beyond climate in all decision-making process at governmental level, but as well as also businesses and finance levels. Thank you.
Thank you, Elizabeth, to have set the scene of this global scene, in fact. Indeed, the global biodiversity framework will be important for the economy and for the investors also. So now I will give the floor to one of you, Vicky. As an investor, as I said before, you have co-founded Carnable Capital in 2017, 5 or 6 years ago, with a focus on sustainability and biodiversity. That was at that time very new, I would say. And how is this issue being taken into account by the market, perhaps more global market? And also, how is it evolving in your own business? Is it easy? Can you take and explain to us, and perhaps also explain to the audience and other investors what is your strategy in terms of biodiversity, and what do you ask to your investees? So all that in 3 minutes, please.
Thank you very much for The Economist for this opportunity, and what a great honor it is to be able to speak with Elizabeth. She's the Bon Jovi of conservation to me, so thank you. When we started Carnable Capital back in 2017, it was a reaction to a realization that half of the world's global GDP is dependent on nature and nature's resources. And despite that, us in the socially responsible investing sector, or ESG sector, back in 2017, had not addressed that with nature specific products. There were a few climate change products back 4 years ago. And as Rachel will attest, we've had 40 years to address climate, and we're finally getting some momentum and scale in the last, I'd say, 5 years. So we knew back when we started Carnable Capital 5 years ago that we, first of all, do not have 40 years to address our nature's problem. It really needs to be addressed now, because it is estimated currently that approximately 25% of nature is under threat, and 1 million species are at risk of going extinct in this next decade. So if you think about the magnitude of that, and some of those species, as Elizabeth and everyone here on this panel will attest, are some of our most iconic species: the Sumatra orangutan, the Asian elephant, the Sumatran tiger. These are species that our grandchildren will remember long after we're gone, and it's our duty to protect them. So again, going back, 25% of species are under threat. And the World Economic Forum has done quite a few studies. One in 2020 that said 80% of those species that are under threat are under threat as a result of 3 socioeconomic sectors. Those include the production of food, which is oceans and traditional land-based agriculture, infrastructure, and the extractive industries, which would include oil and gas. So 25% of nature is affected by our operations in these 3 sectors. So how do we change business? How do we change the operations of these sectors? Well, that's where Carnable Capital comes in, and the finance sector as a whole. If one thinks through the principles of socially responsible investing, that being that by investing in good companies, engaging with those that lag behind, not bad, just companies that lag behind, you can change the trajectory of business operations. And that is why we founded Carnable Capital, was that we would use our research platform to identify companies that outperform with their nature-based risks, and provide at the same time, by investing in those companies that provide outperformance through superior risk management and opportunity harnessment, that we would provide above market returns for our clients, and all the while engaging with companies to improve their practices and those that lag behind. And I know we haven't spoken about it directly, but nothing was better for us at Carnable Capital than in 2020, when we got the call about the pledge group for the Finance for Biodiversity pledge group that launched in September of 2020. And finally, it was a call to action for all financial institutions around the globe to come together and say, let's encourage others to incorporate biodiversity risks, opportunities, and dependencies in their valuations for financing decisions. Meaning banking institutions will consider how a company manages their biodiversity dependencies before they lend to them, or investment institutions, or even insurance institutions, because we all recognize at the pledge which represents now almost $20 trillion in assets collectively, that finance is a lever for which change will happen and we can protect the planet and biodiversity for generations to come.
Thanks a lot, Vicky. As you said, when we speak of the main sectors impacting nature, we mainly hear about agriculture, fisheries, forestry, or infrastructure. Exactly what you said. But we are dealing with another. But you, Sarah, you are dealing with another sector, the real estate sector, and this sector can also have impact on biodiversity. So the asset management as mutual funds that invest in publicly traded real estates on a sustainability basis. And what I would like you to explain to us and to the audience is how is biodiversity being looked in the real estate sector, and what is, once again, your strategy, and what are you asking to your investors? Thanks a lot.
Thank you so much. Thank you so much for the opportunity to speak on this topic. Thank you to The Economist, and thank you to be part of such a great panel. So Vert Asset Management, we started in 2016. We came to market with the concept that ESG was a way to invest in the marketplace, to come to market. It's not an add-on. It's just how you look at companies. Our first mutual fund does invest in publicly traded real estate investment trusts globally on these sustainability criteria. Our E did have biodiversity in the very beginning, but we did over time take that out because our place in the market was to find the data that was available that REITs were reporting out, understand how it was investor ready, and then be able to use that and roll it up for portfolio construction. Well, to be quite frank, biodiversity just was not cutting it for our academics and our investment research group. So we have taken it off, and it is an aspirational piece. And that's where it comes to this panel and the opportunity to be part of the finance pledge for biodiversity, and understanding where the Task Force for Nature-related financial disclosures will end up next year. Because as we've run the fund over the last 4.5 years, we've found that the combination of the Paris Agreement, so international legislation, frameworks, then local regulation, like, for instance, EPC, Energy Performance Certificates, helps companies better orientate their own teams around what it is that they need to report. So something like the Paris Agreement really brought a close focus on greenhouse gas emissions and what those meant. And so no longer was it we were going to come out and ask companies or educate companies what greenhouse gas emissions were and why we needed to get to net zero. It was the conversation had already been started. So both players, the investor and the company, could come to the table with a level set. It does help that the CDP had a report or a framework of questions for the last 2 decades that companies have been reporting to match up with what was now looking closer through regulation. So in the real estate sector, for biodiversity, we're hoping for the same type of strategy, the more clear frameworks. Of course, there's many out there that have been developed and redeveloped and hammered out. It's just having those 3 areas come together, the international framework, and then the more local regulation, and then the non-governmental agencies filling in with the reporting. So in terms of the built environment, over 50% of the world's population lives in a city. Most of the investments that we have in real estate investment trusts, that structure demands that the owner passed through their income, almost nearly 100% of their income. So they are mostly the managers and operators of existing building stock. When we look at it that way, we're thinking of what can the built environment do to reintroduce biodiversity to a pavement landscape, right? What can the company, the building owners do relative to the region where they operate regionally? And so that is the questions that we're going to the companies kind of ad hoc right now, but we want to have that more structured framework, as I've just explained, to really press for more a more concerted effort on their part. We do see some beginnings of this in the UK. The Environmental Act that passed last year, and the Dasgupta review is part of that biodiversity piece. Small sites, they have a small sites log that building owners or developers have to go through a checklist of how they have rehabilitated the area in their specific location. That sort of structured, standardized reporting is super helpful for us as an investor to have the conversation with the company in a productive way that's more standardized across the different regions. I'll leave it there. Thank you so much.
Sarah. Thank you. Thanks a lot, Sarah. So you both are pioneers with some other company in the sector of biodiversity. We've seen, as you said, the importance of the future global framework, biodiversity framework, local regulation, and what about development of markets? That's sometimes not so easy. It's quite new. So that's why I would ask to Rachel, as co-chair of the steering committee of the Voluntary Carbon Markets Integrity Initiative, which is so important in the climate sector. What could you say to Vicky and Sarah and to investors in general? How could this voluntary market help investors to develop biodiversity markets? What are the benefits but also the challenges? Thanks a lot.
Well, thank you very much. It's lovely to be here. Thank you to The Economist for the invitation. So, voluntary use of carbon markets is not new. It's decades old, but it's had a mixed record in being able to bring benefits to those who are rights holders over nature. And so we stand at a slightly different point now in that there is increasing demand for revenue to flow into the protection of nature as we understand the relationship between nature and climate and the economic impact of the destruction of nature that we've seen over the last decades. So there's sort of more awareness, we understand this, and countries really need steady flows of revenues into their ability to adapt and be resilient to climate change, but also to protect and restore nature for multiple purposes. At the same time, we have incredible pressure coming from the financial markets as people have started to make commitments to being net zero, needing to, so both private companies, countries, and the finance sector needing to be able to find ways to make their own transition to net zero, so wanting to access voluntary carbon markets so that they can either offset or find other ways in which to smooth their transitions. Now, the challenge before us is to build a purposeful set of voluntary carbon markets. By that, I mean that the use of voluntary markets must speed us towards that 1.5 degrees that we need to reach the net zero by mid-century. So that means that they have to reduce emissions, and they have to be purposeful in that they direct a steady stream of revenue to countries who need them and respecting the rights holders of nature. Now, if we can do those two things, so that means if we can have integrity in the carbon credits that can be issued, and if we can have integrity in the commitments that companies are making in order to be able to enter into the voluntary carbon markets, then we stand the chance of being able to speed up reductions of emissions and provide a revenue stream that doesn't exist at the moment, and offer new opportunities for Vicky and Sarah to make successful businesses that contribute to these goals. If we can't adhere to high integrity in these markets, then the accusations of greenwash may proliferate and may be true. And I see no value in a voluntary market where we're just moving paper around from one balance sheet to another. We have to be able to find ways to reduce emissions. So in 2022, this critical year, the Voluntary Carbon Markets Integrity Initiative is going to be issuing the first guidance on the demand side for companies entering into these markets in order for us to be assured of the integrity of what they're claiming. And there are other entities and others working on the validation of the integrity of the credits that will be issued by countries and others. And so hopefully by the middle of this year, we'll begin to see the emergence, and we'll start to see first mover companies beginning to beta test the guidance that we come out with and the guardrails we come out with. And then we'll be able to see whether this can work or not, and whether or not we can have people held to account in a productive way. So I think we're beyond the point of just needing markets. We need purposeful markets. We have very clear goals on biodiversity and nature. We have very clear goals in climate change, and we have to use markets to bring those together.
Thanks a lot, Rachel. Yes, the market as we all, and the private above all, alongside the public as we all, an important role to play. And for that, it needs tools and frameworks to be able to act, but also to report on what they are doing in terms of risk, dependency, impacts that materially affect their business, because developing market is a thing, but the business is also affected by the loss of biodiversity. So after the Paris Agreement, the community developed, or the private sector developed the TCFD, the Task Force for Climate-Related Financial Disclosure. And Rachel, you have been strongly involved in that. Now we have the TNFD, and Elizabeth will speak of that after. So Rachel, can you elaborate on the experience of TCFD, this task force dedicated to the management and disclosure of climate-related risk? And ladies, we are very short in time, so I will ask you to answer perhaps shorter than for the first question. Thank you. Rachel, it's to you. The floor is yours.
Thank you. Well, I think the important lessons to be learned from TCFD is that first of all, it came from a letter from the French government and other pressures to the FSB, the Financial Stability Board, which then it created the task force. And that's important because we started to see the political awareness around the fact that holding carbon emissions in your portfolio was actually a macroprudential and a financial risk. So this was understanding risk in the language of the financial markets, as well as understanding risk in terms of climate science. And I think the task force has come forward. There's been a very, very rapid embrace of the concept of risk. You now see more than 58 central bank governors working together to understand this. The task force's recommendations are voluntarily being taken up by more and more companies. You're also starting to see a relationship between the sort of all the companies that measure companies and their performance adhering to TCFD. And I think where we stand now, 7 years really after this all started, is a desire to go from voluntary to mandatory. So such is the climate crisis that we really need TCFD to be taken up by banking regulators and supervisors and made mandatory. And that's what you're going to see happen with more and more rapidity, I think, now across different jurisdictions in the next year, which paves the way, I think, for the extraordinary work being done by Elizabeth and others at TNFD.
Yeah, that's really, really the case. And as you say, the TNFD is now being developed. Elizabeth is the co-chair of the TNFD and face the same issue as you were saying, understanding and explaining to the financial sector what means biodiversity loss, and explaining also to the environmental sector what are the needs and expectation and how the financial sector can do. So Elizabeth, please, can you explain us how this TNFD is being developed and what are the main purposes? Thanks.
Thank you very much. First, we need to understand that disclosure of nature-related risks can indeed be a very powerful tool to convey the systemic, operational, reputational, and other risks posed by biodiversity loss into financial terms and influence decision-making. At the same time, a common disclosure framework will support the alignment of financial flows to nature positive outcomes with the post-2020 Global Biodiversity Framework under development. Yes, you mentioned the Task Force on Nature-Related Financial Disclosure, and this task force actually will help the financial sector to do exactly what is expected. I'm pleased to be the co-chair together with my co-chair, David Craig, a former CEO of Refinitiv. And the task force is basically, or the framework to be developed, it's a market-led initiative developed by the market for the market in collaboration with public development banks, as well as other stakeholders and experts in the biodiversity field. TNFD, or Task Force on Nature-Related Financial Disclosure, aims to provide by 2023 for financial institutions and organizations to be able to report and act on nature-related risks and opportunities in order to support a shift in global financial flows away from nature-negative outcomes towards nature-positive outcomes. And the term nature-related risk is actually referring to the risks and opportunities to an organization posed by the linkages between an organization's activities and nature. At the same time, or in addition to shorter-term financial risk, or what we refer to as material today, which includes the longer-term risks represented by its impacts and dependencies on nature. What does this mean? It means that organizations should disclose not just how nature may positively or negatively impact the organization's immediate financial performance, but also how the organization positively or negatively impacts on nature. And the Task Force on Nature-Related Financial Disclosure, therefore, will build upon the structure, foundations, and experience of the Task Force on Climate Financial-Related Disclosure, as described by Rachel, and harness that synergies to avoid repetition or duplication or contradiction. And we hope that over time, the two frameworks will be complementary to each other. So next month, we hope to provide a better version of the framework, and then we'll develop pilots to test this better framework to enable us to further develop it. And then, of course, in addition to the task force members, about 34, we also have a TNFD alliance, which includes a TNFD forum, which is a global multi-stakeholder consultative network of institutional supporters who actually join us to share views and vision and mission of the TNFD, currently composed of about 250 members. And we hope those who are not yet in it, we invite them also to join, because it's intended to integrate more members and therefore to join this forum. So this is what I can say in short about TNFD, and bearing in time as we've let me stop here.
Thanks a lot, Elizabeth, to explain to all of us what is or what will be the TNFD. So, Sarah and Vicky, I would like to ask you more or less the same question. The TNFD will arrive next year, and will be we all think very, very useful to all of you. In between, how are you measuring your and assessing and managing your risk and impacts on the investing company you are financing? How are you currently proceeding and with your clients also? So Sarah, perhaps first, can you explain us and what are you also expecting from TNFD?
So first of all, Carnable is lucky enough to be a member of the forum for TNFD. But as you may know, back in 2017, there, as Elizabeth, the reason of the TNFD is there was inadequate disclosure from companies regarding their nature, risk, dependencies, and also opportunities and how to mitigate both of those. So we founded Carnable Capital, and we started from the ground up. First identified industries of impact. So we have 16 industries of impact. We did consult with various documents and academics regarding the nature impacts of certain industries. I mean, most people, when they think about nature impacts, they think agriculture, metals and mining, maybe textiles and apparel, nature-based fabrics. But there are pharmaceuticals, for one, also has a huge, tremendous impact on nature, and the chemicals industry. So that was a very exhaustive exercise, was just identifying industries where there were material impacts on nature. Once you've done that, the next part got really is really into the weeds, if you would. We mapped the biodiversity drivers, the loss of biodiversity drivers, which are deforestation, inclusive of habitat destruction, which can affect overfishing in the oceans and the seas. So you have habitat destruction, you have pollution, you have climate change, exploitation of species, and invasive species introduction. We actually took the 5 drivers of biodiversity loss, measured them as best we could on the materiality on those 16 industries of impact. And this is all being done by manual exercise, intellectual exercise by our analysts. We then took those drivers and determined KPIs that were material to that industry. So much like in the real estate industry, as Rachel said, we looked at climate change as a main driver of biodiversity loss for the real estate industry. So you look at greenhouse gas emissions among participants in that industry. After we have done that through the 16 industries of impact, we then determine those who are the leaders by being above the mean for their industry relative to their performance on the biodiversity loss drivers and the KPIs that we've used to measure that. What is great for us is TNFD will take away that manual exercise. And that information has been culled through not just sustainability reports. We also work with NGOs and actually have to call companies to try to determine how to benchmark them. Because again, as a financial management firm, our duty is fiduciary to our shareholders. And we truly believe that investing in those companies that have material nature-based risks and identifying those and investing in those that are the best companies at managing that risk will, in the end, through the investment horizon, provide outperformance for our clients. So we're excited for the framework. Sorry.
Thanks a lot, Vicky. We have just to give the floor to... Yeah. There will be a lot of things to say, I know, but I just want to give the floor for some last words to Sarah. Sorry. And we will have to conclude in 2 minutes. Thank you, Sarah.
Okay, so just quickly, for the success of TNFD, we're hoping that it follows the success that we've had in terms of conversations with companies that we've had with TCFD. TCFD, of course, helps to embed throughout the corporate structure the concept of sustainability rather than it being a remit of the investor relations department or somebody they hire out one person. So we're hoping that TNFD provides a bigger conversation. Of course, in real estate, we're looking at how can the urban environment have more green. How are companies like Landsec in the UK thinking about linking up their buildings for migratory birds? These are the kind of stories that we get here and there, but it's not rolled up in a structured report. So we're hoping TNFD helps with that.
Okay. So, ladies, thanks a lot for all this exchange and this sharing of your great experience. I think that was fantastic insights. Thank you also to our audience. And just join us for the next session, which will start shortly. Thanks again and bye-bye.